What's going on, YouTube? We back with another one. So today what we're gonna be talking about, we're gonna make it real quick, real brief, is risk management and how to calculate your lot size whenever you're getting into a trade. Um, so of course we all know risk management. If you don't know, is the most important thing. Honestly, when it comes to trading, outside of your trading plan and just having an understanding for the market. But outside of that, of course, the best thing to know is how to actually calculate that. So we're just gonna do a quick little detail on it, touch up on it, right? So let's just say you have a $500 account and you're risking 2% per trade, right? Or risking 2% on the trade. So what you're gonna do, you're gonna take that 500, you're going to multiply that by 0.02, and that is going to give you, always have a handy calculator, right? So 500 times 0.02, that's going to give you $10, or 10, which means you can risk $10 on that trade, and that $10 on that trade is equal to your 2% risk of your account balance, right? $2% of account balance. So now that we know what our dollar amount is on the risk, now we have to calculate our position size of this dollar amount. So how we do that mainly depends on how many pips are we risking on this trade. So let's just take, for example, if you're risking $30 or 30 pips on the trade, right? You calculated your stop loss, your take profits, and your stop loss is going to be about 30 pips. So you're just going to take this $10, divide that by your 30 pips. Right, and get something like 0.333333. And then for me, I just sum it up, right, and I always just double check. So this is telling me I can risk 30 cents per pip, right? Because we can't do 33. So you do 30 cents per pip times that by 30 pips. That's gonna equal, even though that's not hard, probably $9, right? 30 cents per pip times 30 pips gonna equal 9. So that means if we want to take a trade on, let's just say GU, stop loss of 30 pips, risking 2% on a $500 account. I don't know if this is in the way or not, right? This is what that's going to look like. All right, boom. I don't know if y'all can see the timer. I think y'all can. So we got a $500 account. We're risking 2%. We're gonna take that 500 times 0.02. That's 2%. If you, of course, go up, maybe 5% is 0.05. If it's, you want to risk 10%, it's 0.10, and so forth, so forth, so forth from that point on. Once you have that dollar amount calculated, right, from that equation, whatever that equals is going to give you your dollar amount risk percentage. From that risk percentage, now you need to calculate your lot toss percentage out of that, which just takes you having to know what your pip amount is on your stop loss. So if you're risking 10, 20, 30 pips or whatever that is, you're just dividing those two numbers. So you're taking your dollar amount divided by whatever amount of pips you're going to be trading, right? So let's just say if you had, like, let's do another example. Let's just say you had like $1,700, right? 17. Oh, now my face is in the way. Let's say you had like a $1,700 account, and you want to risk 5%. Going to take 1,700 times 0.05. That is going to give us 85, right? So that means we have $85 to risk on this trade. Pretty simple. And let's just say we're risking like 63 pips. I'm just pulling numbers out of thin air at this point. All right. So our risk stop loss is 63 pips. So now we're just going to take that $85 divided by that 63 pips. It's going to give us 1.3. 0.34, blue, 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 blue. Whole bunch of extra numbers at the end, which tells us we can actually put bigger lot size on there. So now we're just taking that, gonna do standard $10 a pip, 10 point micro times, what is it, 63 pips? No, not $10 a pip, $1 a pip, 1.3, yeah. So now we move from minis to micro, so we do $1.30 times, well, I'll say 63 pips, 63. So we do $1.30 times 63. That's going to give us 81.9, which is, right below our number because, of course, it was point. So gives us a little bit right below our number there, and that's just how I calculate it. Honestly, whatever it comes out to, I just round. I don't really stress about it too much. As long as I'm under the amount that I want for my maximum risk capital to be on that particular trade, it's cool with me. Let's see if you can do a $1.40 per pip. See, if you try to do a $1.40, you'll get 88.2. That blows your risk capital. So 1.3 is going to be the lot size you're doing. 0.13, which is $1.30 per pip, and that will give you. And you always want to double check your work, right? So you do your 1.3 times that by your 63 pips to make sure the risk capital is still under your maximum risk capital that you're overall trying to risk or have slotted to risk. And honestly, from that point, now you're good. You get in your trade, you set your stop loss, just take profit. Now you know that, okay, I know how much I'm risking on this trade capital wise. Of course, there is the swap fees or the commission fees. So always make sure to calculate your commission fees in with that. Of course, those depend on your broker and whatnot. But quick, simple. That's how you calculate your risk percentage, risk capital, and lot size when it comes to foreign exchange trading. Peace.